It is not that complicated. Building a financial model for your creator brand can be as simple as the following spreadsheet. So, when it comes to telling a narrative of your creator brand, especially if you're considering fundraising for the expansion of this brand, we already spoke in the last couple of videos about what it takes to build a narrative, and we learned from some of the best, like Chamberlain Coffee and Emma Chamberlain. In today's video, I want to peel a few layers back when it comes to how do you actually financially model for something like an additional physical digital product, maybe a service that you want to provide. And we are not basing it off of some sort of like ethereal makeshift scenario where, leads just magically appeared. No, we are assuming very realistic scenario where the leads are actually coming from your business. And I already kind of like listed some of the metrics that we're going to talk about kind of like as a way to drive this discussion. And first and foremost, the easy one that you already have, it's right there in your YouTube studio or your TikTok studio or IG studio, is the number of views, right? And for the sake of being, I'm just going to fill out like an individual single month just to kind of like give you all an idea. And then just because I'm annoying and just because I'm annoying and I like seeing comments. So let's start with 1 million. You can be a lot less, you can be a lot more. I just want to use nice and easy round numbers to kind of like run through this calculation. And it's always a starting point. That's your initial impression. That's your top of the funnel. Next thing is, okay, out of those viewers, a lot of them might be just watching you for the sake of just because they're the fan, they like your personality. Some might just randomly click on the video, they didn't like it and they clicked out. There'll only be a certain percentage of folks who are really in the target market for that product or service. And if you're curious about how do you find those people, who are those people, how do you find them, check out some of my videos on the jobs to be done. I'm going to skip that portion for this video because we're specifically focusing on the modeling. But say we assume that out of all those views, the highest qualified folks are about quarter. So you have about quarter of those folks. I usually like from the perspective of financial modeling, and it's kind of like something common, starting in the investment banking and VC, you're used to marking any hard-coded values in blue and calculated in black. So again, small detail, but it might just show you that you're sophisticated and you really understand what you're talking about. But the idea is that with a 25% conversion rate, you have about real 250,000 of leads every month. Again, assuming the number of million viewers. And out of them, not necessarily everyone will be willing to go and say, click on the link that you provide. So you're in your video, you're talking about a certain topic, and somewhere in the middle of the video or at the end of the video, wherever you place it, you decided to plug like, hey, and by the way, guys, exciting news, I'm releasing this XYZ digital product, physical product, service. Not many of them will click. Really good click-through rate will be anything in the double digits. High single digits, you're already in great shape, right? So from that perspective, you can kind of go and say, okay, so we have about 10% of those folks actually clicking through. So although Google was smart enough to realize what I'm trying to do, we'll just manually tap it in. So you have about 25K of conversions. And then you say, I'm selling a couple of SKUs. Maybe there's like a smaller version of SKU, there's a bigger version of SKU, there's some sort of like a all-in ultimate package of what you're selling, right? Again, ignore for now the specifics for your niche, but let's say you have 3 different. On average, each one of them costs various price. Maybe one is 25, one is 50, one is 100. On average, you expect everyone to buy the one in the middle, right? So you're gonna make about $50 per each one of them. Let's make it dollar signs. Okay, and so now we're already kind of like estimating. Again, it's very aggressive. If it's gonna be your first month, kudos to you, but it might not be the case. We're using it for illustrative purposes, right? So from that perspective, you can kind of like now tell, okay, this is what I might be looking at in the first month. Again, say you're a smaller business, this is more realistic scenario and we can roll with it in case people get too afraid of seeing $1 million per month revenue. They might find it unfeasible. Maybe something like this is more feasible. But you can now start playing around and say like, hey, actually it fluctuates, or my number of viewers can be different. Or maybe how well I qualify can change over the course of the time. But overall, this is where I am. And the good news, you are at this point in pretty solid shape with your revenue. Can it be more sophisticated? Absolutely. But from the perspective of, let me switch so you can see all of me. From the perspective of actual conversations with the investors, from perspective of talking to anyone who might be interested strategically in your business and kind of like try to evaluate, maybe even a new hire, COO or CEO who you're trying to hire, they do not necessarily need at the very beginning very precise math. You are a creator. No one assumes you're going to roll in there with some sort of like 2 cohort analysis with a bunch of different variables and multiple regression models behind it. Something like this just shows and proves like, hey, you understand what it might take and you understand some of the key assumptions behind it. And where you can get them, maybe from some of the ad campaigns that you run and brand campaigns for the other brands. Maybe you've experimented and you've did some things already with a smaller scale, so you kind of have this data, or maybe just making assumptions, right? The good news is that each one of these assumptions can be defended or attacked, so to speak, right? Like someone might ask to show you the stats on your monthly views. Someone asks, hey, how do you assume this? Maybe it's not going to be 25%, maybe it's going to be only 15%. Sure, right? But now it's a discussion, and it's more targeted discussion about very specific kind of like metrics on this visual. And at this point, we're now ready to talk about the costs. And again, the costs, a little bit simple. Maybe you're paying for some like super advanced Shopify. I don't even know off the top of my head, but I suspect maybe it's something about like $250. And let's, again, just because I'm annoying about this, let's make sure we kind of like put in, maybe you're paying per month about $250. Product can differ, right? In the case of specifically what you're currently producing, if it's a physical product, say, although you're selling at an average 50, maybe it costs you $20 shipped, right? With all the input costs around it. So if it's about $20, what we can do, we can write kind of like a simple formula that it's going to be 20 times however many units you sold, right? So you sold 1,500 units. So roughly this is going to be your COGS each month, depending on how many you sell, right? Like, and depending on how you change the conversion rate, it will shift. Again, in some cases, if it's a physical product, you might just be required to buy all of the inventory up front. So it will change a little bit from the perspective of the modeling. But in its own perspective, all you really have to care about right now for this simple model is understanding what your cost of goods, right? And sorry, I should have defined it. COGS stands for cost of goods sold. So in this case, that's why we're kind of like tying it back to what actual conversions were, so to speak, the sales. And we can even specify conversions, sales. So it's a little bit easier for you guys to keep track of. But the idea is that it's really just cost associated with the stuff you sold. So we have that. And maybe you have, just again, makeshift scenario. You have a person administrating all of this, or maybe you hired like one of your friends as a COO and you pay them, I don't know, $4,000. Let's, again, may make it a total number, but basically, so if we'll go with this sum, now we have in front of us our roughly monthly cost when it comes to a business. Again, it can differ, right? You can have service that you're running. If it's a digital service product, you might have more people on the payroll. Maybe you have your own warehouse, so you're renting space in the warehouse. So that's going to be the additional cost. So you just add those line items. As simple as it gets. If you ever created your house kind of like budget, or you budgeted for several different pieces of tech, you list them all out, you assign the cost next to them. Same exact concept. You do this and you essentially start having an idea of what the costs are. And at this point, you kind of like can say like, hey, my target profit at this point will be revenues minus cost, and this is where I am. Again, there's the taxes, there's other things that we need to take into account. Right now, I'm kind of like not overburdening you with this financial model, but all it is just additional line items that you're going to add down the line as you kind of like grow out the model. But the good news is that now you can understand like, hey, if all of this holds, I'm going to be roughly netting out $40K every month. You can start looking at, okay, per viewer, what the metrics is going to look like, and we'll have to expand it a little bit because obviously it's going to be a small number, maybe just a reasonable sense. And then also you would want to understand, oh, this is a profit, sorry. Yep. I was like, why is this number lower than this one? Because I was expecting this number to be a little bit higher. Where are viewer count? This is our viewer count. Boom. And let's expand it also to 2 decimal points. Okay. So, and now the reason why this metric is important, and I kind of like included them, you now have an idea of what your monthly net is, right? And obviously, this is like a great case scenario. In some cases, you might be losing money in the first couple of months as you kind of like ramping up the business. You just have to be realistic about what the scenario looks like. If it looks too good, dumb it down, because I'd rather you always be conservative, especially when you start having initial conversations, so you don't overblow the proportions and set wrong expectations with the investors. That's going to then be expecting you to perform at the levels, right? Be reasonable and be kind of like conservative when it comes to those metrics. And then the reason why the revenue and the profit per viewer is so important, in my opinion, a lot of these conversations will end up being conversations around your future growth, right? How quickly your channel will grow, how quickly your brand will grow, will you improve the conversions at your channel, will you improve the conversions on the actual website when people are picking something to buy? You all of a sudden now start talking about a very important metric, which is your revenue or the profit per viewer or per conversion, right? So you can kind of like bring them up and down and the funnel, so to speak. The importance is as your business scale, it's now easier to articulate to a potential investor like, hey, this is why I think this is a $5-10 million business, because as long as we keep growing at the same trajectory I was growing for the past couple of years at about 20% year over year for the next 3 years, if I grow at this pace and I continue to improve my conversions, maybe our website gets a little bit better, the call to action is a little bit better in my videos to help the conversions, I get more people on the website, more people are buying, so you can see kind of like exponential increase and improvement in the revenue and the profit per viewer. And to kind of like visualize this for you, say you maintained, like, let's copy this and kind of like show for the second month, say you maintain about the same, or maybe you had, I don't know, yeah, let's make it the same, because I want to illustrate the point of how improving some of these conversion metrics can help. You did this, but then you just got a little bit better and you brought it to 17%, right? And all of a sudden, okay, you have a little bit more qualified leads, so there's a little bit of a traffic. Profit and revenue wise, it does not necessarily make that big of a difference. But what if your call to action got a lot better? What if your website got a little bit better? Your packaging of the product and what you're offering got a little bit better, and you also increased it just by another 2%. Notice how substantially more it increases, right? It's basically 30%. I'm sorry, it's about 30K, or percentage wise, it's about 40% increase, right? If we'll do a very quick math. Yeah, so it's a 36% increase in your revenue just from a couple percentage point on conversion. So these numbers start scaling and stacking up in a lot better way once you improve those, right? And so this is why it's kind of like important to illustrate this and show, hey, here's my numbers, revenue per viewer, profit per viewer. And if we just improve some of these things, we're going to get so much better. And potential investor who you're targeting could be the expert in that field who will say, hey, I can actually help you improve some of these metrics. I'm, expert in building websites and call to actions. I'm expert in blah, 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 that can help us improve the conversion. Maybe they're expert in packaging and so on and so forth. So for the investor, their, gears start spinning in their head in terms of like, okay, I can see how I can provide this value and like double this business overnight with my introduction kind of like of my skills into their pipeline. So because of this, you start kind of like giving very actionable data points for someone who you're talking to beyond just, hey, cut me a check. And now that we did all of this, you essentially move into conversations around what the valuation of the company is. And from the valuation perspective, a lot of businesses kind of like come down to revenue multiples, profit multiples, or really EBITDA multiple. I'm kind of like skipping EBITDA because it's a little bit kind of like 2301 finance if you've never done something like this. But the whole idea, if you ever hear EBITDA, it's basically profit, but it also takes into account interest and depreciation, kind of like takes it out of the equation, because if you have a more sophisticated, kind of like more complex financial structure here, you would have also your taxes involved, which is a factor, right? But if you're carrying like an asset, if you own a building, you're going to depreciate it. If you have interest on your debt, if you raise some capital, you have some interest there, you're going to be kind of like expensing that as well. Net, it's at the end of the day, EBITDA is like more complex version of a profit. So think of it, that's why it's a profit multiple, revenue multiple. All businesses go by it. They're more sophisticated kind of like metrics. You'll hear PE ratios, which is kind of like, price to enterprise value. You'll see a couple of other metrics out there that like investors like to use, more sophisticated investors. At the end of the day, when you're selling a startup, 9 times out of 10, people default back to EBITDA/profit multiple or revenue multiple. And in this case, say you look at some comparisons, you look at some of the other acquisitions, and you can actually Google and find that. You can find, hey, what was the revenue multiple on this XYZ acquisition? I've done it for my Emma Chamberlain's video, Chamberlain Coffee video, and we spoke about it. And if I recall correctly, I think it was like 10x or something like that on the business. So we'll say that the multiple on the revenue for the company of this size is about 10x, right? And all of a sudden you can start saying, okay, what is my revenue? This is my revenue. If you go the multiple, that's all it means. All that means is that, hey, the multiple enterprise value equals multiple times the metric. So if it's a revenue multiple times the revenue, if it's profit multiple times the profit. So in this case, all of a sudden, just in month one, you made it an almost $1 million business, right? And again, if we'll just expand for a second, just to see, with that small change, right, of like just in conversion, 2% on the conversion improvement on both ends, you went from 700K to now $1 million business. You legitimately now have $1 million enterprise value business there. Profit multiples, they're usually a little bit higher because, again, they're rewarded more if you're at profit company. They're not always used because some companies, especially in the early stages, might be just burning money and they're not really making profit because they're all focused on growth. That's why you have the revenue metric. in revenue multiple. But say, and again, it might be reasonable, unreasonable, but I'll call it 15x on the profit, which again, we'll just take target profit and we'll multiply it by our multiple. And so from that perspective, you can kind of like see the valuations. Again, depending on which one you use, there can be debates. You can kind of like start looking at the comparisons in the market and who sold at what and kind of like apply it. But long story short, it now gives you the idea of like, okay, what is my business? So if say, again, we'll skip a lot of the months calculations, but say by year 2, you grew your channel to the point where you now see 500,000 viewerships, you really got great at conversions, you really got great at conversions on the website, and your actual, average sale also increased. All of a sudden, by just like, again, I quintupled in some cases and doubled in the other cases the numbers, but just to illustrate the point that if same multiples hold the economy kind of like relatively stable, or the value of those companies kind of value stable, within the next year, by growing some of these metrics and applying the same multiples, instead of sub 1 million business, you're now looking at about $20 million business, right? And as efficiencies kick in, that's where kind of like your profit numbers start flipping over the revenue number. But the idea is that now you can foretell, so to speak, right, if it's the right English, the future of your business, and see like, hey, if we scale some of these metrics, if we really get better at conversion, I'm going to get better as a creator, driving the views. We're going to get better at like, increasing the average checkout basket for our website, and people are going to buy more in a single transaction. We're going to get repeat buyers, another metric that we can talk about in the future. All of a sudden now I'm making it a very valuable business for someone to potentially buy it, right? If that's the goal. Or if you just want to like pat yourself on the back that you build a $20 million business, good on you. The idea is now you have a very quantifiable way to go about it. And beyond that, kind of like you can expand it. Usually I look at the first 2-3 years, especially for the younger company. First, you will be so mental that a lot of the assumptions will change by the year 2. So like year 2 is reasonable. Year 3 is very aspirational. Some people like to do year 4, year 5. It's like at this point, you're like kind of like, sticking the finger up in the air and guessing how the economy will do, what the industry will look like, what the viewership will look like. Will YouTube exist? All of a sudden something happens to it 3 years, 4 years from now, right? Like who knows? Things change at such a rapid pace. 2 to 3 years is the most I probably would go in from the forecasting perspective. Now, beyond that, some of the things I kind of like took as a note will come out in your conversations with potential investors, and kind of like what they would want to see from your modeling, or maybe from just like materials that you present, are some of these metrics. And it's important to just cover them, so at least if they come up, you can kind of like say like, hey, we're not there yet to calculate it, or yes, we have it and here it is. But that's kind of like the idea of bringing them up. CAC is really just cost of acquisition. And the idea is that maybe here we don't have necessarily any cost of acquisition directly, right? Unless you can kind of like count maybe the website as part of it. But in reality, it can be the fact that your videos produce money. Your videos cost money to produce, right? So to acquire those 100,000 viewers, you on average spend $2,000, right? And someone can say, okay, if it's at $2,000, and at the end of the day, I'm getting about, let's make it 2,000 for this metric because it's easier math then. It costs you about $2,000, right? So now I can say that my cost of acquisition to get in one sale is about $1 per acquisition, right? Per customer. And it's a very reasonable place to be in. Some companies can be at 5, some companies can be at the 10. And you would want to include it sometimes in the cost of actual business running. There is some argument to be made that you will spend that money anyway, so it's not really related to this business. So you can kind of like start talking to a professional like myself, or someone who you're working with on potential pitch, about what's included, what's not. But ultimately, when people ask you about cost of acquisition, it all boils down to how much money does it take you to get a single customer. And that's it. And maybe you're running ads, maybe you're running and expensing a lot on your video production. At the end of the day, that money kind of like then divided by the total number of customers you have, and roughly you get at the CAC. LTV, lifetime value. The idea of the lifetime value is actually an important one, depending on which product niche you're in. Lifetime value of the customer is essentially the idea that hopefully they're not just buying a single time, right? They're going to be your customer now for X number of months. If you're producing something, and maybe, I don't know, it's very basic cooking gear. I like using cooking channels as an example because I feel like it translates in any geography, in any country, in any language, right? Is that if you're producing cooking equipment, but it's really like base level cooking equipment, you would assume that the customer would buy your tools for the first couple of years of their cooking career, so to speak, right, of their experience cooking, but eventually they would want to get like more expensive knives or maybe more expensive tools because they're now really getting into it, and they'll stop buying from you because they would want to upgrade from the type of equipment that you're selling. And you can say, okay, that means that although on average they're buying $50 per purchase, but they're only buying from me once a year, and they're only going to buy for the next couple of years. So your lifetime value of the customer is 2 years time to purchases because they only buy once a year. It's $100. So this is your LTV. Your lifetime value of the customer to your brand is about $100. And the reason why it's important because it starts giving some perspective for the investor. Obviously higher LTV, right? If that's like a recurring thing, maybe again, coffee, and they're constantly buying coffee. And if they really like it, someone who loves coffee and they really got into that specific type of coffee, they're probably going to be buying it for the next like 5 years, maybe 10 years, right? From you, as long as you exist. So their lifetime value will be completely different, right? If they're buying every month $10 worth of coffee, so it's $120 per year for the next 10 years, all of a sudden your LTV is $1,200, right? So you can kind of start seeing how those numbers scale. And the reason why it's important, especially in conjunction with the cost of acquisition, for the investor, I can start thinking, okay, this business has very low LTV, right? Meaning lifetime value. Once we acquire a customer, we're not going to extract too much, but the cost of acquisition is pretty high. That's actually not a good, efficient business, right? It can still be doable. It just not be as interesting for them to invest because they will have to spend and help you spend a lot more to get those people in the doors. And once they're in the doors, they're not going to spend as much money within your business. So that kind of like gives them the idea of scale. And inversely, if your cost acquisition is like cents on a dollar, but they're going to spend their LTVs like $10,000, this is an amazing business. You want to like pour money as much as possible in a customer acquisition so that you can get as many of them through the doors, because once you get them through the doors, you're guaranteed about $10,000 per customer for the next 5 years, for example, right? Like again, very aggressive assumption that they're spending something like $2,000 per year on your brand, but that's the idea. Like this becomes a very lucrative business, right? And it becomes important for an investor to understand it because they will know kind of like, hey, as we scale some of these metrics, how much can we see in return? And that's where like LTV is important, and especially with conjunction with CAC. And then CPM is cost per mil. I think it's like per milli. I'm forgetting exactly. I think it's a Latin word, but basically it's per thousand, right? So if your cost was $1 per individual conversion over here, your cost per thousand is $1,000, right? As well as RPM, your revenue per thousand. Oh, I'm sorry. I'm looking at the viewers. I should not be. It's per month because this will be. I was like, this is ridiculous. It's going to be per viewer, right? So if it costs you about, again, to acquire a certain number of folks, say your video again costs $2,000, and it's a $2,000 for the entire video, and it gives you 100,000 people. So essentially, all you really need to do is you're gonna say $2,000 divided by the total number of viewers that I got that month. So it's about 2 cents. So it's about basically 2 cents per viewer, and then you can say, okay, if that I got 1,000 viewers, so it's about $20. So your CPM on this specific video, which is kind of like expensive, is about $20, right? And similarly, for the revenue perspective, you basically just go and you say, okay, but from the revenue perspective, I'm making 45K, right? So you can start saying like, okay, I'm sorry, 100K. This is divided by our total number of viewers, and then this times 1,000. So your actual RPM, right, is a lot. It's $1,000. This is a great number to be at, right? Again, aggressive scenario. We recognize that, right? Like, but the idea is that you are getting over $1,000 RPM for this specific type of business, right? And again, the idea is that it indicates the scale. It indicates that as I'm growing this number of viewers, as you grow that number of viewers on your channel and you continue to convert, right? This is basically the indication of scale for your investor. And similarly for any kind of like other metric that is derivative. So anytime you're going to hear something that indicates number of revenue per viewers, per customers, per conversions, per leads, cost per viewers, per customers, per conversion, per lead, those are all indication of scale. At the end of the day, what the investor trying to get at is, if I help you improve the conversion on the website, improve the conversion at say the video, or help you kind of like grow your channel, improve the number of viewers you get, they get the idea of the scale for this business. And it also gives the idea of the levers, right? If you put them all next to each other and you realize like, hey, my biggest lever right now based on these metrics is that I make a lot more money per each 1,000 new viewers on the channel. So now it gives you the idea of the conversation can start happening like, hey, if all other assumptions hold, what we need to do, we need to figure out how do we get you in front of more viewers, and we get more viewers and hopefully the same type of viewers so that all the conversion metrics hold. Great, it's a one type of conversation. Or maybe, hey, your viewers really do not matter as much in the sense of like the scale, they don't contribute as much, but the conversion on the website does. Now we start talking to specialists about the website conversions, about the packaging, the pricing, to make sure we can increase that metric. And the more we increase that metric, the better our end outcome becomes. Again, at the end of the day, as I said earlier, people like to throw some overly complex financial models out there. This is as complex as it gets. At the very bottom line, when you show that you understand what your revenue is composed of, what your cost composed of, you can give an idea of the profits, you can give an idea of some of the derivative metrics, and you can start talking about enterprise value. That's it. Again, as the business matures, as you come up with different ways by which you're going to grow the business, as you maybe talk to a little bit more sophisticated investors, you can start making an argument that, hey, I need more complexity here. I need my taxes, I need the interest, we're going to have the debt financing, so I need to include it in here. My payroll will now include like 10 people, so I need to overcomplicate things. At that point, you're going to very likely be able to afford like, professional finance individual or like operation individual like myself will come in and help you kind of like build out the more complex version of this model. At the very beginning, especially if it's the first time you're raising funds or you're just trying to kind of like figure out in your brain, hey, what it's going to look like and what are kind of like the levers? How can I make the money? Where do I need to focus? Can I realistically sell something on average at $50 every month to a number of my viewers? All of these assumptions can now be tested. And this is my only takeaway from all of this, is that don't overcomplicate the calculation side of things. Calculations are easy. This model, I'll make sure I'll link it down in the description with this video. Just go copy it in your Google Drive and use it, whatever. Build it your own. It's very simple. It'll take you like 10 minutes to build it out. More important part are all the assumptions around it. Like, how likely are you to convert people? How many of them will convert? What's going to be the pricing of the product? Can you sell the product at that price? Are there other competitors out there who are selling this product at that price? How frequently do they sell it? How frequently do people buy it, right? Like, those are the key assumptions because they show that you really understand the business that you're walking into, and it will show the investor that you're not like somewhere in the clouds. Where I've had plenty of anecdotes, but one I'll mention because one of my favorites. Back in my PE days, we had a company that was pitched to us. They were trying to sell plastic cups with team logos on them. And I kid you not, their financial model showed that in the first year, we're going to make $75 million on that. They literally had zero sales at that point, or maybe like 10,000 sales, $10,000 of sales or something like this. It's like from 10,000 to 75 million in a year. I'd love to be there with any type of business, but that alone is already unrealistic unless, I don't know, you're selling crack cocaine probably. It's like you cannot get to those, which by the way, illegal and as a joke. Worth mentioning because I don't know how the algorithms work, but it's way too much. It's too big of a gap, right? Like there needs to be realistic expansion. There needs to be realistic assumptions. There need to be realistic assumptions behind the product where like you're selling plastic cups. They're so easy to fake. They're so easy to pick up. Any other company will do it. There's no licensing fee assumptions. Like will actually all NFL teams approve it? Like there's so much goes on. Why would NFL teams, if that's how much money they can make, why would an NFL team allow you to make that revenue? They're just going to sell those cups on their own, right? Like you can start completely peeling apart that idea and kind of like showing in how many different ways it's not going to work. You don't want to be in that situation. You don't want to be that person who shows up in front of an investor, gives them this like pie in the sky scenario, and it can be easily just like, like a Jenga tower, just with a single hit, just completely be taken apart, right? You want to make sure all those assumptions are real, they're realistic. You maybe show some comparison. You can show like, hey, by the way, the reason why I think this assumption makes sense because this competitor is selling at this, but we can do much better because my product is better or because I have a better attention of the audience and their social media sucks. Different ways by which you can now start talking through these assumptions, which are very simple and they all kind of like you're either generating the top of the funnel, converting that funnel, what the ultimate sale is at the conversion, and then some additional costs of like how do you actually supply the product or service or maintain the infrastructure like a website or like a warehouse to go and sell it. So I hope it was useful. I'm like, what? Yeah. Oh, shoot. I am still about 30 minutes. I was trying to make it like a 20-minute video, but I hope it helps from the perspective of understanding it's not that complex. If you're curious, you can always reach out. We can always chat through your assumptions. You can take a stab at it and be like, here, I'm stuck. Does it make sense? And I can quickly review it, respond to you over the email, or we just go find some time and chat live about it. Always happy to do it. But I hopefully I demystified for you the whole idea of the financial modeling around the creator brand. People who are trying to charge you a bunch of money to do this kind of work will make it seem like it's some rocket science. It is not. First few passes, you can do it on your own. As long as you know some basic math or you just play around a little bit with Google Sheet, you have it there. You have someone like me to help you for free. And from then on out, as you get more complex, and hopefully you get more revenue, we can talk about something more complex, which will require some investment from you. But right now, it's as simple as this model. So go take a stab at it, see if it makes sense for your brand. Make sure you're buttoned up on all of those assumptions. And I think you might be ready to have a couple of your first initial investment conversations. Let me know in the comment section below if you have other questions. Otherwise, I'll see you next week where we're going to break down some of the important distinctions from the investment perspective and who might actually be interested in seeing this kind of model versus who might not even need the numbers yet. They might just want to just check the vibes with your business. I'll see you next Saturday. Peace.